Okay, hi there, welcome to this Elsewhen webinar. My name is Matt Soczywko. I'm head of marketing here at Elsewhen. If you're not familiar, Elsewhen is a digital product consultancy. So for our clients, we provide digital strategy, senior product teams, and we often lead on customer experience for large-scale digital transformation programs. We work with clients in insurance, very obviously financial services and beyond. For example, we worked with Zego, who are a major player in on-demand insurance, which is what we're talking about today. So today we're going to be talking about the growth of on-demand insurance, and we've got a great panel to help us do that. So I'll let them introduce themselves, but first up we have Mark Huxley of Cognitive Risk, which is a company we partner with. So Mark.
Thank you, Matt. Nice to meet everybody. So as Matt said, Cognitive Risk is an innovation consultancy founded last year with Matt Carter, also on the call. And its idea, both Matt and I come from the Lloyd's insurance market and spent most of our life navigating around it. And it's an agent for change and innovation consultancy. So that's kind of what the business does. Me more generally, I've had a long career as an entrepreneur, and much of it is around growth strategy, strategic consulting, and more latterly mentoring the people that work in those businesses.
And Matt?
Yeah, so Matt Carter, hi. As you said, last year co-founded Cognitive Risk with Mark, but 30 plus years in insurance and technology. First job was as a Lloyd's broker, again, set up a number of businesses. Interestingly, as we come in, Cognitive Risk has been established to help technology companies navigate the nuance of the London specialist market and also the specialist insurers and insurers generally understand where technology can play a much more of a pivotal role in their business. So that's me.
Perfect. And also on the call, we've got Patrick Smith of Tribe Advisory. Patrick?
Hello, thanks, Matt, and good afternoon, everybody. I'm co-founder of Tribe Advisory, and we're a risk and insurance intermediary. We focus on groups, affinities, and sharing economy platforms. I've had all of my career in the risk and insurance space, either designing, buying, or selling. And amongst our clients, we have a number of gig economy platforms as clients, including Deliveroo, where we arrange the insurances for all of their riders worldwide. And interestingly, on the flip side, I'm also their Deliveroo's corporate insurance leader. So I look after all of their corporate insurance needs, as well as those of the freelance community upon which they rely.
Great. So perhaps we'll come back to Deliveroo and the gig economy, but we also have joining us Leon Gauhman, who works with me at Elsewhen. Leon?
Hello, great to be here. My name is Leon. I'm Director of Product and Strategy at Elsewhen. I've been working closely with clients in insurance sector, Elsewhen clients like Zego, Bupa, GoCompare. I'm looking forward to the webinar.
Brilliant. All right. Well, thanks for joining us all, guys. So today we're talking about the on-demand insurance market in the UK, but more specifically, we're talking about the sustainability of on-demand as a business model and the potential for future growth in on-demand insurance. Patrick, perhaps I'll come to you first. So one context for the growth of on-demand insurance you started to hint at there is the gig economy. And on-demand insurance, you could say, grew out of having to serve this emergent gig economy. With that in mind, do you think that the gig economy is here to stay? Is it destined to grow? You mentioned you work closely with Deliveroo. Perhaps you could talk about that.
Yeah, so good question, and you know, the short answer is, in my opinion, 100% yes. But I think it's worth sort of pulling back and trying to decide what the gig economy really is, because it's a relatively new phrase that we're very used to now talking about the gig economy, like we know exactly what it is. But of course, you know, the concept of people doing gigs and being freelance is very established. And for example, you know, one of our clients at Tribe is a community of surveyors, many of whom are running their own businesses. They're sole practitioners, you know, single firm directors, as well as the kind of more modern type of gig economy worker, you know, that has emerged over the last few years, such as food delivery with the likes of Deliveroo, Uber Eats, Just Eat, and so forth, and obviously Amazon. You know, as emphasised, I suppose, by our current COVID-19 experience, that now everything comes to me. I don't have to go anywhere, principally because I'm not allowed. So I think you know, scoping the gig economy is an important thing to do, and recognizing that some very established traditional trades are actually in that group. What I'd also see is, even with the current challenges, the appetite for flexible working and being in control of one's own portfolio, I don't see has been diminished. The appetite isn't diminished. The challenges of at what cost that freedom, obviously the challenges are being highlighted at the moment. But I think also in considering the growth of the gig economy, you know, I think for many years now, the concept of an employee having a job for life, I think that's long gone. And I think, you know, when we read the headlines this week, last week, and no doubt next week, we'll find legions of people who had the kind of blanket of employment to support them being removed either by virtue of furlough or reduced salary for a period of time, voluntarily, but, you know, voluntarily in inverted commas. And of course, you know, many thousands of redundancies announced and coming down the line. So, you know, I think conceptually the societal move towards being in personal control of what we do, I don't see that diminishing, and I don't see there being a reduction in the kind of platforms or organizations who would seek to rely on freelancers rather than employed staff. So from my perspective, I think one of the positive outcomes of COVID-19, for example, will be increased potential volume for summer gig economy workers, tempered with the challenge of actually running your working life as a business rather than as a, you know, dare I say it, as a paid hobby. So I think shining the light on how a gig economy worker protects themselves is going to be key critical, and I think on-demand insurance clearly has its part to play.
Yeah, in terms of, so if we sort of take it as a given that the gig economy is here to stay. Oh, bit of an echo there. So if we take it that as given, especially with what's going on now, the gig economy is kind of here to stay and set to grow, and many people who perhaps don't count themselves as part of it now, you know, increasingly employers are going to shift to these kind of models. What is, do we think, the relevance to the customer for on-demand insurance? Mark, perhaps let's jump in there.
Yeah, I suppose it's the kind of specialist over generalist. I mean, you know, many people that are running existing businesses and they have the traditional infrastructure, you know, cognitive will be one, Tribe will be another, you know, Elsewhen is another. That the kind of insurance policies go out are really quite broad and general to cover quite a wide landscape of activities that you'll do. People that are working freelance, and if they're, you know, by nature they're going to work in one single line of business, the insurance need that they're going to have to really reflect that one need that is going to exist. So if you are a Deliveroo driver, quite clearly a lot of what you're going to have in there is kind of carriage risks of you know, taking food around, so, you know, road traffic act type things in there. If you're a a freelance creative, then you're probably going to end up much more thinking about IP and some of the design work that you're going to do. Copying and plagiarism. Consultancies like Matt and I run with Cognitive. A lot of what we're doing is intellectual thought giving in, and boards are making decisions off the back of it. So I think the specificity of the insurance, I think, is one thing, but it's also the turning on and turning off. And I think kind of Pat touched on it. There is a lot of people out there that they want to work for the freedom of working. So actually, they might just want to work 3 weeks a month. They don't really want to buy a policy that's going to be on all of the time. The ability to be able to turn policies on, turn policies off, is going to be very much now to the fore. So that you don't feel like there's a wastage of insurance risk sitting in there.
Totally. So, I mean, it makes perfect sense, right? It's enormously important to these types of customers that they don't have to buy, like you're saying, long-term premiums to cover themselves for insurance. And clearly, there's a demand now that these emergent types of businesses that are looking to employ people within the gig economy. If we take it, sort of think now, because we haven't really spoken about the incumbent insurance world. What's the word? What's the sort of the call to action, if you like, for the big guys who perhaps are not used to pricing and selling insurance products in this way? Do they understand this market? Is there an appetite to serve this market? Is it being sort of forced on them? Matt, you could jump in there, but open to anyone really.
Yeah. So I think it's the reality is that whilst, as Pat said, the gig economy in its truest sense has been around for a long time, but through the lens of an insurer or an incumbent, it's relatively new. And what you're having is the platforms, in much the same way that the credit cards held inordinate amount of data over and beyond the supermarkets and the retailers that were effectively facilitating the transactions. We've now got platforms being created by those that serve the gig economy that are consuming and creating inordinate amounts of data, profiling behaviors. And I think it's that transition of taking the data that exists on an individual basis, as the behaviors and needs and wants, and translating that back into a risk profile and insurance. Typically, there's a challenge around productization. The products that exist now need to be reimagined. And as we move into that, we've also got the reality, as Mark said, about the specificity of the coverage not being fit for purpose for those in the gig economy. And I think I'd like to just also bounce back to, as an insurer is looking at this, looking at the art of the possible. The reality is there's going to be a lot of data is going to be thrown up about behavioural needs and activities that needs to be mined and worked out for some insights and building out new profiles. But more often it's about understanding and getting through to building risks that are around micro periods, whether it be a movement between A to B, is that's the only period on risk is a very small element of time, which in theory, logic suggests only commands a small premium in compared to the traditional. So there's that bit. And I think I'd just like to go back right to the beginning. What I think is interesting is that even today, the gig economy and on-demand insurance is got a lens of people on bikes and in cars delivering things. But as Patrick sort of alluded to, I think this change in perception behaviours, whereby there could be some very, and there already are, in a sense, very serious and significant professional personnel who require protection and products, who are operating at a level far above the typical gig economy worker on a relatively low hourly rate. So products have got to be crafted to meet a very broad church of requirements.
I've just come back, Matt. You framed the question about the kind of incumbent insurers. There has to be a pivot point for the incumbents where the gig economy is still a minority part of the commercial world. So as a traditional insurer, they're there to put the majority risk in for the majority people that are going to be their customers, and it's very hard for them to then pivot with any kind of agility into a complete new market until they see some market saturation. So to not criticize them, you know, they've performed very well. They're fit for purpose for the way the world has grown up. But it's this kind of, you know, enfant terrible of these new economies that are coming in behind it that are looking for the specific covers. And it's tough when a large business has been built on one thing, just to say, you know, overnight it's going to move to the other, which, you know, and I think insurance has been a wee bit slow to it. But the growth of the insurtech community, managing general agents, in our vernacular insurance, MGAs that sit in there, they're typically kind of somewhere between a broker distributor and an underwriter technician that's actually taking the risk on, working on behalf of incumbent insurance capital, so they give them the capacity to write the risks, the financial solvency capacity to do it. That's why they've really come forward as a really strong business model, because they can get under the skin of these gig economy, small niches, you know, the monoline, I have one need and I need to do it well, and actually flex their business model to be able to react to it, but with the security that the rest of UK Insurance PLC that puts in behind it. So I don't think it's an either or, and it's not, you know, incumbents versus others. It's a case of how do we keep moving the market forward to a point where it becomes obvious to an incumbent that they need to do things. And credit to a few companies that tried hard at it. Aviva, you know, just near neighbours to you guys up in Shoreditch, they opened up a garage up there a few years back to try and innovate and ideate some of this new thinking coming out and launch some businesses around it. You know, Matt and I particularly, you know, we as we said, we both work a lot around Lloyd's. They have an innovation lab in there where they're inviting a dozen companies in twice a year, startups and scale-ups, to actually be exposed to that incumbent market. And it's a lovely push and pull that goes on between the two communities, where, you know, you could put it, being slightly kind of overstating the point, that a very large incumbent Lloyd syndicate can go and play with a small startup, but actually the ideas that come out from those startups and the way it moves the needle of thinking for the incumbent, you know, there's some really good relationships that have been born out of that, and Lloyd's have changed some of their methodologies of working, not directly as a cause to it, but in part way, where they now have what they call a syndicate in a box. So it's basically a small packaged, you know, produced micro insurance solution that can sit alongside the giants. So they're opening up the environment to do it. So there is a move forward, but I just think, like turning an oil tanker, you know, it's always going to take a few miles before it turns around.
But I think the very nature of some of the largest companies in the world, and certainly over the last, say, 10 years, the fast growth companies, these are companies with massive potential future earnings and revenues that actually have very little in the way of assets. And of course, most insurance was predicated on 80% of every company's value being in some sort of asset base. So really, property insurance was the starting point. And actually, many of the kind of sharing economy platforms are really more akin to matchmaking dating sites than they are to we own stuff and we sell stuff in the conventional way. And I think that I accept exactly what you say and agree totally, Mark, with, you know, the startups. And one of the issues for the big insurers is picking which startup actually is going to fly. Because on the other side of the spectrum, you look at some organizations, and if we were to pull up, you know, the largest companies in the world, top 10, you'd probably find that 8 of them we'd never heard of 10 years ago. And actually, so it's those companies that initiate, start, are successful and grow rapidly, are pushing the agenda, and, you know, you would say are creating the urgency amongst the insurance industry to respond. And I think the other thing that strikes me is if you've got modern consumerism that is basically saying, actually, we want things immediately, on demand. I want to be able to turn it off if I don't want it anymore. I want things to be kind of disposable. So I don't want to buy a film, I want to rent a film for a night, and then I'm not bothered anymore. It's kind of changed the way in which people buy stuff, and insurance is not immune to those kind of rhythms and changes in buying behavior. But of course, the only way really to respond with some of the physical aspects of on-demand consumerism is you need a flexible resource to meet that. And actually, flexible resource comes from the gig economy. It doesn't come from building mammoth teams of employed people. And I think the last point I was going to make at this point, referring to insurers, is I think insurance is a really weird industry because it was born out of quite clear, massive risk taking at its birth. And over the years, as it's grown, it could be argued that many have lost the sense of entrepreneurial ism. So if the two challenges for a large insurer is how do I underwrite this, and or how do I service it, if your starting point is let's see how we can modify what we've always done, you'll probably never get to the answer of that question. If your disposition isn't, okay, how do we do this, rather than what are the constraints to doing it, you're likely to be inhibited as a large organization to make those changes. And this is what's given the opportunity. You mentioned it for firms like Zego, Mark Swearman, and the other kind of the new intermediary who's saying, actually, you just provide the capacity, we'll be the entrepreneurial front end, because we're closer to what the client needs, what the platform needs, what the consumer needs, what the gig economy worker needs. And therefore, the stress then is to tailor insurable risks into bundles and packages and digitalized experiences that make sense in this very sort of bite-sized world that we now live in.
I think it's really important to frame one thing that Patrick said there, because again, we spend our life in violent agreement with each other about stuff, and I think part of the problem in the insurance industry, it has a reputational issue. It's one of those out with estate agents and law firms and politicians that is easy to snipe at for all the bad that it does. Much of it, as an insider, and I'm sure others would agree, kind of unwanted and not right. But I think there is an inequality in that relationship between the insurance carrier and its customer. It's very master-servant. Everything is loaded to the side of the insurance business. It's their wording, their policy, their premium. They're an expert. The 35 to 50 page type policy that an SME will have put in front of them, written often in Chaucerian English. It's just not a happy place to start from. So it ends up as a not quite a grudge purchase, but it can end up feeling a bit that way because it's something that a customer feels they have to buy, but they don't have an aspiration to buy it. The grudge is it's being sold by an insurance business that they have no control over. And I think if we establish that as a point of principle in the going forward for the gig economy and the on-demand type insurance, it's actually equalizing that relationship. So the customer is actually then fully sitting at the heart of this relationship, and they have the ability to shape the relationship with their insurer and not be dictated to by the insurer about what they're going to take out. And I think that's been part of the slow to move. If you're ABC Insurance Company, you're writing £1 billion a year of SME insurance, why would you change it? Because 50 gig economy companies come along and say that we need that needle of change. And that's a societal change. And I think Patrick said it before, that outside of the backwaters and ennui of insurance, people are doing that. The on-demand world, the living off a smartphone, just buying stuff when you want it, the convenience of now and mass customization, again, Amazon type experience of, we all shop on Amazon, but our 5 shopping experiences will all be different to each other because they get to understand who we are and they make us feel valuable in part of their own business value chain. And I think that's a good principle that we need to adopt as an industry. And I think for this debate, if we're accepting that point, that's the trigger on, I think, for where the on-demand insurance has a real opportunity to completely break new ground and you know, create green fields of what it wants to do.
Just so I understand you, Mark. Oh, so I'll just jump in there really quickly. So you're making the examples from digital people at Amazon, where they have customer experience, customer centricity at their core, and they're from a world where perhaps owning that interface with the customer is everything. Are you suggesting? Do you think that, you know, for lack of a better word, you'll use it again, but the incumbent insurers, that's where they should be being? Or do you think, because there's an alternative, right, which is by collaborating, you provide the underlying insurance products and structure, but you work with insurtechs and different companies who may be better placed to own that relationship with the customer in a way that's easy, right? You know, you walk up to the car you're going to rent, and your insurance is part of that experience through your iPhone. You don't go separately to Aviva or Matt. I can see you're
no, yeah. It's so Matt, all the points you've made, to take Mark's point, is absolutely on the money, because you're looking at an incumbent position and a historic position. Back to Patrick's point of asset bases changing. It's the transition of moving from a payer relationship of indemnity to a partner relationship. And the deeper the partnership goes, the more entwined it is with from technology, then you're going to start getting back to the win-wins that effectively cement any long-term new relationship, which is to the benefit of both parties, to your point. So the movement from any traditional thinking of indemnity and paying as in a response to a claim to a wording, but moving to understand that, you know, the direction of travel, the things that are very different now that are actually the critical and board talking points for some of the platform businesses or Uber are going to be vastly different to something with massive property bases and assets, as Pat already touched on. So I think that sort of, I'd hope, you know, brings everything into a perspective of we're all getting down into a move of having to become closer together and be able to respond at the time of need, wherever that is in the chain for on demand. And on demand is obviously very timely by its nature.
And I think to play to what you guys do at Elsewhen, I think there are new job titles coming into the insurance world that a decade ago weren't there. You have customer experience people, you've got, you know, user experience, you've got design-led thinking. So, you know, it's not an operational thing, it's just a strategic and a philosophical thing that businesses need to change. And, you know, Matt touches on it because that gets led by the board at the top of the company. So if the board had the willingness to say, actually, do you know what, our business model, it was fine 10 years ago, but it's not really fit for customer, we've got to move that out. Now, you know, knowing that you guys work around the banking industry, you know, one looks at the period between 2008 and the financial crisis then, and well, I won't say to today because today's not a good day, but, you know, a couple of months back today, that you now live in a world where actually banks have put all of the customer need at the front of what they do. I'm a lifelong Barclays man. I got bored with Barclays, but I like Barclays again now because they actually thought about me and what I need as a businessman and in my personal life. You know, Matt and I use Starling, you know, for our business, and you see the challenger banks and how they're coming in, and that feels like that's where that pivot and that relationship's getting more equalised. Where, you know, insurance. Sorry, I'm doing this trying to do on screen. Insurance is still a little bit apart, but, you know, you can see it coming together.
Yeah, I think one of the things that insurance has struggled to unlock is the power of data. So I always think about large insurers and actually who holds the key on a deal. And often it's not the marketing guy or the sales guy or the product leader. It's actually the actuary and his model. And I think one of the difficulties or one of the transitions insurance needs to flow through is to how are they using data to determine the real risk profile of the things they're looking at. Now, if I take a simple example, you know, I've got a car on my drive that I don't really use these days very much, but my motor insurance is absolutely obsessed with my with my postcode, whether I've got a garage, whether if it's on the street, whether it's under a headlight, and all of that stuff. Well, the big risk is me and how I behave. I'm the big risk. Actually, where I leave my car is not a big risk. And I think the benefit of organizations that you would say are really data organizations gaining data through a service, they actually know how people behave. And I think until insurance can use that data to determine some potentially slightly different risk metrics, then it's going to struggle, I think, to get to a very responsive, proactive, almost as far away from the annual insurance policy as you can get. I mean, terms and benefits could change overnight because of what you're doing here and there. And we know you're doing it because we're plumbing into some of your activity based, just like we've got a Fitbit on you. We know where you are, we know what you're doing, we know how you're getting there, how quickly, and so forth. And I think one of the challenges for the insurance industry is, challenge A is whether they've got data or not, and I think that's a different issue, but assuming they've got a capacity to gather data and use it to drive out premium, is it the right data set? Because actually a lot of businesses are doing away with all kind of these fixed facts and are more into what's actually happening from a behavioral perspective.
And I think just to literally to take on that, I mean, curiosity is so crucial for any business. But you know, as Pat says, the reality is there's a lot of data out there, but we need people to consume it and be curious with it to try and find better insights, which then leads into product innovation and service innovation and the like. That's so being curious is super important, you know.
Yeah, and a simple example right now, I suppose, is the car I referred to on my drive. I don't think I've driven for 2 months. So actually, what use is an annual insurance policy for me? Because I've been money for nothing for 2 months. There's been no risk whatsoever. The car hasn't moved. Now, in a behaviorally based world, of course, my provider would know I've not moved. They would say, are you still alive? We notice you've not moved. Oh, you are. Why don't we ramp back, and we can ramp back up when you start to be mobile again? And you know, it's kind of that push-pull, and actually insurance is, and even the law that governs it is very reactive. We react to what you tell us rather than what we either know or what we could get to know through data and technology. And that will be a big shift when that happens.
There's it's a really interesting point. We've got a question that speaks to that. We actually got a question from an attendee, comes from Mark Andrews. So thanks for this, Mark. Because there's kind of two bits to that, Patrick, in terms of the challenge to insurers serving your use case there. There's a kind of a cultural block potentially, which is like, maybe culture isn't the right word, but do we desire to rethink the way that we price risk? Do we want to rethink the way that we put together these policies and these products? And then there's a technological block, right? You know, we're not in the place. How do we get to the place where we can use things like telematics to actually price and, you know, think about risk and build products? With that in mind, Mark Andrews' question was, do you think the on-demand startup insurers, or MGAs, will take market share from incumbents who are still offering annual policies? Or do you think actually really there's more opportunities for them in emerging risks? You know, meaning are they going to eat the breakfast of the incumbents, or are there other areas that aren't touched in the market that they'd be better placed looking at?
I'll put a quick kind of historical perspective to it and kind of maybe go back to when Direct Line started, for kind of those of us old enough to remember that. You know, it was seen as a novelty on the side and not a threat. And at that time I was working for a Lloyd's business that had a very large motor syndicate, and I remember going through a year of sitting in various meetings of, you know, kind of Direct Line being ignored as some kind of odd little bit of noise on the side. until they realised they were capturing some market share. And I think that the word, I think, to answer to Mark's question about the kind of sea to change is the word fear. And the fear started coming in amongst the incumbents that actually these are stealing the food off our table. So whilst they could be ignored, there was a real kind of sea change of how do we get the word direct into everything we're doing, because that was the kind of buzzword and the sexy word of the time to get in there, into a point where eventually everybody learned to play nicely with each other. And and again, we mustn't be binary that it's either all on demand or all annual. The whole thing does need to play kindly with each other, because Patrick has another part of his business and his life, the risk management part of it for large corporates. They don't need on-demand insurance; they need on-stream insurance the whole time. So the two will eventually, I think, come play nicely. But if it's hopefully answering Mark's question from my perspective, I think that needle will start moving amongst incumbents when they actually properly see fear and actually have to do things for themselves. Because go back to what I did say earlier about the managing general agents out there, they can coexist because the incumbent can basically give a nice big war chest of money to the managing general agent to actually underwrite risks on their behalf. So it's a no operating cost. It's just purely paid on the fees and the overriders that are paid to that MGA. But the MGA is then the little agile business that's going to capture, and that's a good current model, and that feels like a good pathway for a while. That's my 2 pence.
I think that.
Well, I was going to go on.
Go on, Leon.
Yep. Matt, who's
Leon? I think you were first.
I jumped. So I think that the Insurtech ecosystem is just one step. So you can see, like, on demand is a current topic because that's one of the first niches that's been occupied by innovators. And this is everything that's been said so far. Focus on the customer. This is where the next battle is going to be won, and this is what everybody understands, and that's the opportunity that the Insurtech see, the ability to solve a customer problem and give them what they want, which the insurance industry has been historically very unwilling to do, and now waking up to a reality where there are new markets and potentially some of their ecosystem is being shifted away. And I think in one of the things that wakes verticals in a most frightening way is actually attention of the GAFAs, and the Insurtechs is just the first. It's kind of like death by 1,000 cuts. It's kind of opportunities being taken away, new markets explored that the current ecosystem is too slow to arrive at. But like I think Patrick said, the top 10 companies on S&P 500 are, the biggest companies weren't there 10 years ago, and those are majority currently tech companies, and they are gobbling up everything. And there's absolutely no reason why one of these giants should not address the insurance market. They have the customer, they have the pockets, they have the technology. And for me, I think that would be a much scarier and bigger wake-up call where whole markets could potentially just disappear overnight. So I think it's fintechs are kind of the canary in the coal mine, if you will.
Yeah, that's really interesting.
I would
go on, Matt.
So taking on Leon's point, I mean, Mark's question, it's historically whether insurtechs will effectively eat the breakfast of the incumbents. The reality is, I think, is that those that have the platforms or have the direct, have the customer and therefore the customer need, it'll be those they feel they can partner with most beneficially. So historically, insurance companies were able to do a bank assurance because the insurance company and the bank were very analogous in terms of their structure, their layers. They had 58 different departments. They could all talk to each other. Today, a platform provider, if we use Uber, is going to want to, an engineering team is going to want to talk to an engineering team very quickly and have very, very fluid conversations. So they need to, wherever they find that best, I think, is where the fit will go, which may ultimately lend itself to startups because there's a better fit. But equally, it may well be that incumbents end up start buying some of the startups to give them that specific niche agility that they need on the edges. So actually, a business model becomes a hub and spoke, and the spokes become business lines or business model focused. May well be a direction of travel potentially.
Yeah, I think there's one other thing I would add to that is that you can't underestimate what the consumer looks for, and actually what they perceive as strong, reliable, ethical brands is actually a real magnet to doing business. So I think you're absolutely right that those particularly sort of consumer centric brands that are rapidly growing actually will be regarded by customers as the safer place to be. But you know your brand value is like a snapshot in a moment of time. So consumerist behavior now is, I'm going to give something a go. Actually, if it doesn't work, I want to turn it off and try something alternative. And if I fancy, I quite like to go back again. So I think the brand value of insurers, you know, amongst some of the people that Tribe serves, isn't particularly regarded as, you know, the thing. It's and certainly I would say it's not necessarily as important to customers, certainly in personal lines, that the insurers would like to think. So you know, I don't think we can forget the consumer base and their appetite to consume non-mandatory insurance. And I think the other thing that, you know, I've noticed is much of the insurance that we design, arrange and provide actually is for risks that up till now have not been insured. So as well as kind of eating someone else's dinner, you're actually bringing new insurable risk to the market. And there's a real playoff between, you know, those platforms that rely on freelance communities. Of course, there may be a desire without risk to the employment status of freelancers to provide support through insurance as a mechanism. But of course, the platforms themselves have considerations around what does this mean in terms of our role and responsibility to these freelancers. What about things like vicarious liability for freelancers and the overall sort of employment law? So the two things are not necessarily in the gig economy, sharing economy, are kind of divorced from each other. And this is why it's really difficult for companies and potentially some of their advisors to, it's hard to focus on one piece of the jigsaw to the exclusion of the others. And I suppose the last point that, you know, I've noticed insurers somewhat struggle with, and it's very glib to say, well, large companies are siloed. It's probably true, but it's a bit glib. But actually, when you look at the construction of insurance, it's really line by line class of business driven. Whereas actually, many of our customers, they're not interested in that. They actually want a little bundle with maybe 4 or 5 classes of business, all in a bundle. They only want to buy just a little suite of stuff. And I think sometimes the class orientation of insurers or the insurance market makes it hard actually in that structure to bring together little small kind of hourly, per job, daily, monthly bundles of stuff. It's hard to manufacture if you start from the proposition that for liability we go to our liability experts, for property we go to our property experts, for personal accident, well, now we're into accident and health, and we've got a whole separate team over here. You see what I mean? To get into small bundles, for many insurers, just too hard. And one of the difficulties they have is really imagining what's the size of the prize. And I routinely talk to insurers that their appetite dwindles because I don't have a book of 100,000 policyholders. What I've got is I've got something that I'm going to grow into 100,000 policyholders, and actually people want gross written premium and they want volume right up front. Well, actually, the world's not like that. You know, it's a bit like, you know, the guy who didn't sign the Beatles. You know, if only you'd known. And actually, once they're big, everybody's interested. So it's about looking very carefully at what you think strategically the world's going to look like in, say, 5 years' time, and who are the winners. You know,
sorry, Pat. One thing I'd say on that is I absolutely agree with that, and the insurance very badly walked its way up to 5-6 years ago of kind of mass commoditization. If it could just do one thing and sell it to anybody, that kept their cost per acquisition right down. You know, I didn't say it in my introduction, but you know, I've been quite instrumental in founding an insurtech business 5-6 years ago. The big premise of that was to go from mass commoditization into mass customization, and actually all of it was about driving people to the power of one, because we recognized when we were talking about the business that part of the issue of insurance, of it being sold, not bought by the consumer, was no one actually felt it worked for them. And all it was about gaps and cracks in it that just wasn't going to suit for people. So the march forward in that time, and I still think it's got a way to go with it, is again learning the Amazon type experience. You know, what's more mass commoditized than books, given what they originally sold, let alone everything else. But what they've taken is that commoditized experience down to a very customized. This is what is going to work for you. You know, Matt, you've got a lovely bookshelf behind you full of books there. You're clearly, you know, very, very careful and caring about the books that you buy. But you know, Amazon know you, and they're filling your bookshelf full of the books you actually want. You know, and that's the big step across the Rubicon that I still feel the insurance industry hasn't yet fully embraced, for the reasons that Patrick said. That, you know, why would we do that? You know, we can do a one job and sell it to 1 million people and make £1 billion, you know, in premium, whatever the losses are. But why would we make that change to actually get down to a power of one? Because we're going to have to work a little bit harder. The cost of acquisition is going to go up. Without getting over technical in the way, you know, insurance businesses are running, they're not actually making a huge amount of money. That's pre-COVID, let alone what's going on at the moment. The operating costs of these businesses are quite high. So where's the appetite for change that comes in? You know, and that's another.
But I think, yeah, I think there's some brilliant sort of corporate case studies in other sectors. So if you look at the kind of Harley Davidson story, so late 60s, early 70s, the company was crunched. You know, it was virtually out of business. You know, the thing they discovered was by chance that actually, if they could sell bikes where you could adjust the height of the seat, that was really interesting to consumers. They did that, all right, and now a Harley Davidson will cost you £3,000 more than a Honda Goldwing, and arguably the Honda Goldwing goes better and for longer and less leaky. So you know, there are other lessons, and the one I want to avoid, of course, is the Kodak lesson. That, you know, as the company failed, they did have the best dark rooms in the world. All right.
Yeah.
They missed the point. People didn't want dark rooms. So it was an irrelevant brilliance that they had, because the world had moved on. But I think, you know, I think sort of change can be, it needs to be an energetic evolution. It doesn't mean here today we stop doing this and we start doing that. All right. But you've got to evolve, and you do that by learning. You do that by a lot of listening. And actually, some of the sacred cows of the insurance, you know, of the insurance industry, they quite clearly have stood the test of time. Actually, now to challenge all of those.
So, I mean, I think it's interesting. One of the things about product innovation, of course, is to be able to walk in the shoes of your customer, and those in the gig economy and on demand who are doing maybe multiple jobs. That's not that's not a happy space or a comfortable space for those in the, for all of us around the insurance industry. But COVID and post-COVID, maybe we've all had a little bit of an awakening about what being more independent is like, and we can apply that back to some of our product design thinking, for our product design for customers both in the gig economy and outside as well, because it's all become a little bit more independent of mind and thought.
Yeah, there's the parallels from you've been talking about with the industry. I'm a little bit closer to banking and financial services in some of the things that I worked with at Elsewhen, and the parallels in terms are crazy. There's so many in terms of a sort of presumed trust in certain household name brands that just doesn't exist anymore for younger demographics. This idea of selling products, rather than thinking in terms of customers and what your customers think, and then the looming threat of GAFA, who think in terms of owning the customer. They're not. They don't have. Patrick, talking about your silos. The guys at the GAFAs who are thinking about banking, they don't have a mortgage silo and a lending silo. They're not tied to these historical sort of banking products to turn a profit. And they have a sense of this cohort of one that we all sort of started talking about. Things like your Instagram experience, your Amazon experience is getting close to a cohort of one experience, which feels many miles away. It seems like, and there's this idea of what's going to be, therefore, the fintech moment in insurance. Matt, you started to hint there that perhaps COVID is this kind of this accelerator, but I'm wondering if there's something around customer centricity, which is something that we talk a lot about at Elsewhen. Leon, you kind of talk about you're in the business of speaking to very large companies and dealing with the real structural roadblocks, and often they say they want to be customer centric, they say they want the customer experience, but there's very real structural challenges that stops them from doing that. Do you think they're likely to kind of get out of this? It's all very well to say COVID, we have to do something, but there's
It's interesting to see kind of the value chain, and if you look at the insurers, you have this incredibly inflexible base, which is almost like a utility, that on top of which this value chain is built. You have the underwriting, which is essentially data modeling, something that can be completely automated, and then you have the brokers, which are the channels that are need to be turned into customer first, slick, delightful propositions. Through that entire kind of chain, things in the sector really have a huge opportunity to change. And that sort of end-to-end change will enable a really quality, different customer-first propositions. And as a techie, when I look at this, I see a huge opportunity. I'm sure that's not goes unnoticed in other sectors and by other people, but there's potentially something along the line legislation that needs to happen the same way as open banking happened for financial services, to really bring the the point home that these huge companies that sit on this cash capital and allow these ecosystems to exist and provide the utilities for it are actually going to be turned into utilities and open them up and remove the technical barriers away from other businesses being able to build on this infrastructure, same as telco, same as financial services, same as utilities. The operational costs is something that I think Mark mentioned. Operational costs and underwriting is something that being cleared away in financial services by many businesses. This is a lot of opportunity is based on that only, of replacing manual labor, kind of the dark arts with of underwriting with machines, completely streamlining that pipeline. And on a consumer side, when you compare kind of propositions. And even if you look at the insurtechs, you know, there's nothing, you know, is there a place for a beloved insurance brand? Is there a place for, you know, we're talking about kind of top 10 brands. I'm sure that there's not a single insurance logo in there. Is there a place to create something like that, to create a relationship with the customer where people are telling, you know, you have to use this, you need to be on this, you need to, you know, Monzo, get on Monzo, you know, like the kind of having is that possible to dream that consumers are going to be excited about insurance? Why not? It's happening everywhere else. So I think there's a huge opportunity for customer centricity. The insurtechs are the first ones aligning into that direction, awakening this sector. But there's, you know, there is a possibility of a tech company looking at this and just sliding in because they don't have any of the legacy, and that could be a very scary moment for a lot of different execs, I think.
Yeah, Patrick, you talked about which we talk about in financial services with platforms, possibly a stage beyond what Leon is describing, where you're just free to switch between providers, right? And really you have no brand loyalty. There's a platform owner, perhaps sorry, that is serving their products on the platform, but ultimately it's sorry about that. It's kind of open to those platform owners to try and sell their products to the consumer, but actually what we want is true customer experience, right? And I don't want to have to pick and choose, you know, and work out exactly where I'm going to get the best deal. And those kind of things would be automated. But perhaps in the medium term, like we've seen with challenger banks, that actually there is a place for the Monzos and the Revoluts of this world who are serving a need right now. And actually they do have, there's a new kind of brand for a certain demographic, there is a new kind of brand loyalty. There is a sort of, you know, that iconic orange card, there is a place in the market for that. So I think that's quite interesting, because I don't think I totally take your point where you're seeing insurance going eventually, but in terms of the maturity of the ecosystem, we're not quite at that point, are we, where my iPhone just picks the best premium for me from minute to minute. You know,
yeah, and I think the transitionary period you talk about, it is really understanding what kind of brand gains consumer loyalty and what kind of brand is irrelevant to most consumers. So it's very difficult, I think, you know, deciding as an unloved brand to develop a sub brand that will suddenly become loved because, you know, it's got kind of, you know, Z's in the title. It's far more than, you know, groovy names, really. It's more about, I think, brands and solutions that to the consumer give them the confidence you understand what I'm about. So, I mean, we're working on a project at the moment, which is for musicians, and the success of the product won't be actually these heads of cover or these limits. It will be the mindfulness of the product that says to the consumer, we know what you need, and actually we know what you don't need. So we're not going to deal with any upgrades of stuff that's pretty superfluous. We're going to knock out stuff you don't need. We're going to leave in the stuff you do need. And we're going to lead your thoughts right here, right now, where in fact the target market aren't earning any money at all whatsoever. So actually, you know, if I digress, the opportunity is right here, right now, because I think when everything's going smoothly, people only think about insurance, either when they have to pay a premium or they've got a claim. Other than that, it's probably the last thing they think about. Right here, right now, actually the ability for many people to think to themselves, did I really protect myself as well as I could do here? Because I've now got nothing. I think that's the opportunity for insurance and risk transfer to play its part. But actually, our life is not one big video, it's a series of photographs. So if we come out of lockdown by the new year, the world will have moved on and we won't be thinking about lockdown anymore. So you've got to be dexterous and fleet of foot to strategically be able to strike in the moment of opportunity, threat, or opportunity, whilst having, I think, this kind of entrepreneurial-led process that says, actually, no one knows what the world's going to look like in 6 months' time, but when something changes, I want to be ready to change with it, whatever that, rather than I'm just going to hold on to my business model. And it's only a phase and it'll all come back. Well, not necessarily so.
Totally, I think, yeah. So I'm conscious of the time, and I'm conscious that you guys have been really generous with your time and sharing your ideas here. But I think maybe that's a good takeaway, which is that the insurers shouldn't be thinking purely in terms of what's going on right now in terms of COVID, and equally they shouldn't be thinking that there is going to be some kind of return to normalcy once this is all over. There is an enormous opportunity to be thinking about the very meaningful ways that the world is going to change and that insurance is going to change, and the change is either they can either be kind of architects of that change or it might happen to them. I'm sure I can see Mark and Matt are dying to jump in on that. We're out of time. Thanks everybody for being involved with this. I'm sure we'll do another one of these soon. To everybody who tuned in, thank you. A recording is going to be available. We're going to email that to everybody who signed up, and we'll be sharing that on our LinkedIn channel. I encourage everybody to check out Tribe Advisory and Cognitive Risk, and of course, Elsewhen. All right. Thanks a lot, guys. I'll see you again soon.
Thank you.
Thank you.
Thanks.